Welcome back. I am happy to introduce Caitlin Holton-Kuntz of Fredrikson and Bryon, who will be presenting on the topic vendor contract considerations in mergers and acquisitions. Caitlin Holton-Kuntz is a senior associate at Fredrikson and Bryon. She represents banks and other financial institutions in a variety of regulatory, merger and acquisition, and other transactional matters. In addition, Caitlin routinely negotiates critical contracts with bank vendors, including core processing agreements and drafts customer agreements. Having grown up in a community banking family, Caitlin has dedicated her practice to helping the community banking industry thrive. You'll find a printout of the presentation slides in your folder, and of course they are also available online. Please help me to welcome Caitlin Holton-Kuntz.
Thank you, Tom. I'm actually going to use this podium because I can see better. All right. Well, good afternoon. Thank you for joining us, and a big thank you to Tom and his team. I know we are all absolutely thrilled to be back here together in person, and it took a lot of doing to get us here, so much appreciated. As Tom said, I'm Caitlin Holton-Kuntz. I am with Fredrikson and Bryon. My practice focuses on a variety of banking matters, including the two blended topics we have today, M&A and vendor contracts. A little bit about me as we get started. As Tom said, I've been with Fredrikson for about 4 years now. Before that, I cut my teeth doing regulatory work in-house for a large local bank. But I'm also one of you. I'm a fifth-generation community banker, and I grew up, coloring under the boardroom table and flicking sugar cubes at the commercial lenders in the break room while I should have been doing my homework. But point being, this industry really matters to me. That's why I do this. Oops, and I'm missing the clicker. Ha-ha. Anybody in this room who's done a transaction recently can tell you that vendor contracts have become an incredible part of this process. I don't think this was the case all that many years ago, but it's evolved quite a bit. It has really become sort of the headache du jour, I think it's fair to say. When you pick up the phone to call your attorney, your investment banker, to start that conversation about engaging in a transaction, I can pretty much guarantee you that one of the questions they will ask you in that first conversation is, have you taken a look at your biggest vendor contracts? All of these things on the screen, these are only a few of the considerations that actually matter, that come into play and wreak havoc on the operational process of deal work. Termination fees, conversion fees, usage fees, lots of fees, no surprise. Conversion scheduling, exclusivity, making sure your products line up, notice requirements, figuring out where all your records are, all of this stuff. And all of that is separate from the actual nitty-gritty of the operational side of actually merging two portfolios. So as you can tell, it's become a really important piece of this. So much so that your advisors actually have started to refer to your vendors as the shareholder you didn't know you had. And full credit to Craig Mueller for that quote, by the way. All right. If we did a survey of all of the bankers in this room, I can pretty much guarantee you most of you have a scary contract drawer. With the advent of modern technology, that may have shifted to be a scary Windows folder, but the concept is the same. I have one, I'll fess up. It's at home, by the way, not in my office. But it's a Twilight Zone-esque place where all of the copies of the contracts you accumulate over the years just sort of get put for safekeeping, where you don't really ever have to look at them. And to be fair, you don't often have to look at them. Generally speaking, you can file them away, and when they come up for renewal or you have questions about where to send a notice, you can pull them out, but they're not day-to-day reference documents. But over the years, this becomes kind of a huge mess. It turns into an unruly stack of old invoices, exhibits that you don't know if are still current, schedules for products you're not sure if you still have, master agreements that have been renegotiated, random invoices from 2007, and my personal favorite, the agreements that have been renegotiated or have been with vendors who've changed hands so many times over the years, been purged out of existence, that, you know, it's a completely different entity than it was when you signed the original documents back in 1998, which happens a lot. And, you know, the truth really is that as good as our industry has gotten at vendor management from a risk management perspective and from a regulatory perspective, you know, we're not as good at this organizational side of it. You know, we can all manage a spreadsheet that have renewal dates and termination fees and notice periods in it, but the larger question of, you know, collecting all of this information and knowing what to do with it, all that ancillary stuff, is a little more challenging. And I would bet that most of you, unless you've renegotiated it in the last, you know, year or so and it's readily available in your inbox, if I asked you today to pull out a full copy of your current core processing contract with all of the exhibits, all of the schedules, all of the ancillary stuff, all of the NDAs, it's harder than you think. We talk a lot about core processing because it is the biggest contract you have, right? It's the most expensive, you're most dependent on it, and it has the most influence over your day-to-day operations. But there's a lot more than core when it comes to talking about the contracts that matter in a transaction. All of this stuff on the screen, all of these guys also have termination fees. They have assignment provisions. They have notice requirements. They have exclusivity provisions. All of this stuff matters, so it's important to look beyond Jack Henry or Fiserv. All right. So, you're ready to start a transaction, or ready to start thinking about a transaction, let's put it. Some things to consider, right? If you're on the seller side, there are things you can do now, even if you haven't, you know, identified a potential transaction, even if it's not a reality yet. If you know that it might be on the horizon, strategically speaking, some things you can do to make your life and your lawyers' lives easier when you get to that process. You've decided to sell your bank. What are some things you can do? Track down current copies of your contracts. Complete current copies. Again, it is harder than you think. Calculate your early termination fees. Read through those contracts. Give it a try. See if you can come up with a rough estimate. Check for deconversion fees. People forget about this one. It is expensive, and you may have sticker shock if you don't think about that before you go into it. Deconversion timing is another one. Vendor schedules are tough, especially when you're dealing with a deconverting vendor, a converting vendor, and a target closing date. Making those things line up is difficult. And then notice and consent provisions. At this stage, just figure out where they are in your contract, figure out what they are. So let's go through each of those in a little bit more detail. Establish your existing contracts. Figure out what you've actually got. You know, the big ones are easy, right? You've got your Jack Henry contract, you've got your Elan contract, you've got Shazam, et cetera, et cetera. But crack open that drawer and see what else is in it. And cast a wide net. You know, be pretty inclusive. Think critically about the services that the bank uses on a day-to-day basis. Think about what contracts govern those. You know, you've got armored car, you've got ATM servicing, all of that kind of stuff. Similarly, make sure all of the stuff has all of the stuff. Look for you know, your schedules, your exhibits, the ancillary documents that make up the whole contract. Those things legitimately matter, especially when you're going to be combining two sets of portfolios and two sets of services. Knowing exactly what's in each one is very important. And secondarily, on that got everything provision, at this stage, you know, the due diligence stage of your transaction is one thing, right? You're getting all the information together. You're turning some things over to potential buyers. You're figuring out what you've got. But at some point, you're going to negotiate a purchase agreement. And that purchase agreement is going to come with disclosure schedules. And I can tell you, more often than not, the contract schedules are the most painful part because we got to dig through, figure out what needs to be disclosed. Something's always missing. I promise you, if you do some work now to figure out that organizational side and get the ducks in the row, it'll save you time, it'll save you legal fees, it'll save you headache. Update your contracts. There's a good chance that scary drawer has some really old stuff in it. If you've got a master agreement from 2002, good chance that it's been renegotiated since then. Or the vendor has sent you an updated copy, even if it's just, a terms and conditions style document. There's probably an updated one floating around there somewhere. And ultimately, if you can't find all these copies, if you can't track down the stuff, call your vendor. They definitely have it. Don't be afraid to shoot them an email or reach out and say, hey, I'm trying to wrap my arms around it. Can you send me a complete and current copy of our relationship with all the exhibits and all the schedules? They'll be able to help you out. Early termination fees. So this is probably the number one thing that most of us in the room think about when we hear vendor contracts and a transaction in the same sentence. And with good reason, right? Some of these are quite literally reaching into the millions of dollars. I've seen a lot of those lately. That's a big deal point, right? That's a lot of money. So much so that we often see early termination fees discussed in offering memoranda. They usually make it into LOIs. Who's going to pay for what, how much things are. So expect that to be a big deal point for you. Couple of tips on that, though. Not all of your early termination fees are going to live in the same part of your contract. Most contracts, and you guys probably know exactly what I'm talking about, there's one chunk where it specifically talks about early termination fees, and that's where it says, you pay 80% or 75% or whatever of the remaining monthly fees multiplied by the number of months left in your contract. That's not necessarily the be-all and end-all of what you might owe on early termination. In particular, and it happens a lot in core contracts, as you guys know, if you've negotiated any kind of discounts or credits, anything on the front end where you're getting some perk from the vendor, some financial incentive, find those provisions in your contract. There's a really good chance that they say, if you terminate early, you owe all of that money back. Sometimes it's prorated, sometimes it's not. And those amounts add up really quickly. And second pro tip here, give the calculation a shot yourself. Definitely important to know where those provisions live. Give it a shot and see if you can carry them through and see how the math works on your end. But confirm them with the vendors. Vendors have something of a black box when it comes to calculating early termination fees. And very frequently, the calculation that you or I will do on the front end is different than what they come up with when they put it through their own mechanisms. So important to get both and then compare them, right? And if something doesn't look right to you, talk to the vendor about it. Deconversion. We typically think of the conversion stuff as being more the buyer's problem, right? You're stuck with all this stuff afterward. You figure it out. But that's definitely not the case. There's a lot of front-end work that is worth doing on the seller's end to make sure that some of the deconversion ducks are in a row in advance. Some of the contracts you have might have predetermined deconversion fees. It's becoming more popular to negotiate those in. Others are going to be really non-specific and give the vendors a lot of leeway on what to charge you for deconversion purposes, or say something like then current rates or market costs. Others don't mention it at all. So it may be a conversation you have to start from scratch. And with fees, of course, comes scheduling. As anybody who's gone through any conversion or deconversion, whether as part of a transaction or not, knows that it's really tough to get on their schedules these days. Sometimes you call those vendors and there's a good chance that The big guys, the Jack Henrys, the FISs, are booking, 12, 18 months out right now. That's crazy. And that doesn't fit necessarily with deal time frames either. So always good to have that in the back of your head. And another little tip, don't forget that some of your stuff is interconnected. Actually, a lot of it is. Sometimes that comes in the form of one Fiserv contract with lots of third-party stuff stacked underneath it, but Fiserv is in charge of that relationship. That still takes some doing. Most of that is on Fiserv's end, right? But there's coordination that has to happen there. But also, you've got a whole bunch of other vendors who are interconnected into your core platform, into your website, that are going to matter. And you have to get all of the parties at the table to make sure all of the deconversion stuff lines up. So have a good idea of who's interconnected and what services rely on others, and all the parties you need to be lined up to talk to. And a quick note on the deconversion stuff. Granted, there's only so much you can do in advance, right? Before you've identified a merger partner or a buyer, before you know a lot of the fact-specific stuff that's going to go into the mechanics of deconversion, that's going to change, right? So the idea is not to have all of the answers as you go into it, but simply to be cognizant of the answers you're going to have to come up with at some point. Notice and consent. This is part of contracts that a lot of us as bankers overlook on a pretty frequent basis. Very few contracts allow you to terminate or assign them with no notice or consent from the vendor. Very few. Look through your contracts and see what provisions are in there. They're usually at the back. They're usually in that sort of boilerplate nonsense that nobody likes to read. And they're usually pretty short and sweet and straightforward. But give them a look. Find them. See what the actual requirements are. Plan, for both termination and for assignment of your contracts. You don't know yet what your buyer's going to want to do. You don't necessarily know yet if you're looking at a merger or a change in control where, the notice and consent stuff is going to change based on how the contract or how the transaction is set up. So get your arms around both, right? If you're going to terminate a contract, know what the notice requirements are to do that. Sometimes it's 30 days. Sometimes it's 60 days. Sometimes it's 180. And if your average merger time frame is about 4 months, roughly, from the time you sign an agreement, that doesn't necessarily line up with all of those dates. So, good to know. One other thing to remember, assignment means different things in contracts. Sometimes contracts will have really specific definitions of what assignment means. Sometimes it will include a merger. Sometimes it won't. Sometimes it will include a change in control where the bank itself isn't changing, the party to the contract isn't changing, but control of the bank is. Vendors who are really used to working with banks almost always have a change in control provision in there that ties with regulatory definitions of changes in control. So make sure you track those down. And one more to note on the assignment stuff. There are some hoops in some contracts when it comes to assignment. It's not always necessarily send your vendor a short and sweet letter that says, hey, we're being sold, wanted to let you know, the bills go here now. Sometimes vendors have due diligence rights, for example, that they get to do on your proposed assignee, on your buyer. And that's not unreasonable if you think about it. They want to make sure that all the effort they went through when they decided to take you on as a partner and make sure you were somebody that they wanted to do business with, they might want to do that again. Even if it's not in your contract, there's a good chance your vendor will ask some of those questions when you give them notice. And ultimately, even if your contract doesn't actually require notice or consent, it's unusual, but it does exist. In practice, it's still a good thing to do, if only because there often are logistics to work through that might not otherwise occur, even if it's just the bills go here now. Your vendors need to know some of that information, so it's usually worth it to at least give them a heads up. Give them an opportunity to let you know if there's anything that they need from you to ensure a smooth transition. All right, talked a lot about the selling side of things. Let's flip the coin and go to the buyer side of things. And ultimately, it's a lot of the same questions and problems with different agenda. You still have to talk about conversion, but this time it's conversion, not deconversion. And this time you are talking to your own vendors. They are very important in this process. Talk about those schedules with them in advance. Talk about the fees with your vendors. Fees both for the conversion process, and check what fees in your contract might be changing, or whatever contracts happen to survive. Good chance some of those fees are going to increase, decrease, shift a little bit after the transaction. And then decide what to keep and what to terminate. That's kind of a question for down the road, but it's good to start thinking about it now. Conversion schedules. Same comments as before, really. These schedules fill up really far in advance. And there's a lot of work that goes into the converting vendor side of things, and they do need to be able to schedule that well enough in advance and commit enough resources to it. So make sure you're having those conversations with them early. And secondarily to that, when you convert, has a lot of effects on a lot of different deal points, right? Namely, your closing date, that's important. Most, in a traditional deal, right, you close on a Friday, you convert over the weekend, everybody wakes up Monday and it's a brand new bank. That still happens a lot, but we also see some different approaches to that, especially these days when the conversion schedules are challenging, leading to that, temporary manual processing option, where you've got 2 core processors on 2 banks. You got a legal merge date where the banks legally merge into one institution, but because you're not on the core processor's conversion schedules yet, in the background, you're still running 2 banks. You have 2 sets of records that you are then manually merging from 2 different systems. It's a lot of work, so that could be an option that you face looking at. Kind of in line with that same one, if you're going to need any post-closing services or wind-up type things from the vendors that are being deconverted, right? I mean, it may be that not everything is going to happen on the same day. So you may need some holdover services and start, thinking about what those might be. And then, of course, payment of your early termination fees. When you terminate and convert a contract, really decides when you pay your early termination fees and how much they end up being. So worth thinking about. And, not to put too fine a point on it, but these things all matter pretty significantly to your regulators. When you go to file an application and say, we got a transaction coming down the pipeline, here's what we've agreed to, they're going to ask you about this operational stuff. Recently, all of them, especially all the federal regulators, have been asking about this in a lot of detail. They want to know about your conversion date. They want to know about shared services. They want to know if you're going to try to do a 2-step merger. So these details matter for more than just, your own strategic and operational purposes. Fees, everybody's favorite. There's a lot of fees. Transactions are incredibly expensive, if you hadn't already guessed. But the cost of your transaction is not your purchase price, right? That's only part of it. And so making sure you understand all of the fees that are going to be involved in a potential transaction is important. It's important operationally, but it's important to your board. It's important strategically. So deconversion and conversion fees, we all know those. Some of them are pre-negotiated, check and see. Others, you may have to have a lot of back and forth with the vendors to figure out what they're actually going to be. Early termination and assignment fees. Assignment fees do exist, by the way. They're unusual, but they might be in your contracts, especially certain types of contracts. If there's going to be a lot of work for a vendor to accept the assignment of your contract, there might be a fee attached to it, so check for that. And then your post-closing changes, right? There's a really good chance that if you are the buyer and you're moving a new portfolio of branches and loans and deposits and customers onto your existing platforms and software, your pricing's going to change. Sometimes you drop, into a different pricing bucket where you're getting a better deal, but ultimately your pricing is likely to go up, right? Because you got pricing that's based on asset size. Well, your asset size is going to go up. Pricing that's based on the number of accounts or the number of transactions that the platform handles in a month, that's going up. Or the number of seat licenses you need. If it's a software contract that, right now you've got 6 mortgage lenders and 3 deposit people who need access to a certain platform. Well, if you bring on 3 new branches and that comes with 2 new mortgage lenders and 3 new deposit people, those are additional licenses you're going to have to talk to your vendor about and make sure that you know what's going to be involved in that from a payment perspective. But bottom line, get a good idea of what your actual transaction price tag is. Yes, your purchase price is the bulk of it. Absolutely. But there's a lot of little stuff that adds up in the background, especially when it comes to your vendor contracts and the operational bits and pieces of combining 2 entities. Keep or cancel. And granted, this is really one that's not completely doable until you've identified a merger partner or a seller, because you don't know what's out there, right? You don't know the nitty-gritty, the bits and pieces, what services you might need that they have that you don't need, but they are going to continue to need. All of those mechanics aren't in place yet, but you can still think about it strategically. For any contracts that are going to be terminated, as we've talked about, a couple of times now, know the fees, know the notice requirements, coordinate with the seller. It's not possible for one party to bear all of the responsibility for this stuff. You have to do it cooperatively. So don't be afraid of those conversations. And then, for any that are going to be kept, even if just temporarily, right? Even if you're going to do that 2-step merger where you might need 6 months or 3 months or whatever, or if you're doing a stock purchase now with the intention of doing a legal merge later, some of the same considerations, right? Check the assignment requirements and check the exclusivity requirements. This is a big one that we collectively all tend to forget about, but it's important. Most of your big contracts, your core contract certainly, some of your credit card and debit card processing contracts, that kind of stuff, they have exclusivity provisions in them that say you will get these services from us and only us. And if you go forth and get these services from somebody else, that's either an event of default and they can cancel you, or it comes with some big fees. So good to know if you're going to run afoul of any of those, and sometimes it happens accidentally. One particular thing to keep in mind with exclusivity stuff, some of your contracts are at the holding company level, not the bank level. So if you are a holding company and you are going to buy a new subsidiary bank, 2 charters, going to stay that way, great. You're going to take the existing bank's existing core contract. If the holding company contract has an exclusivity provision in it that's enterprise-wide, you've just broken that. If you bring in a new vendor under the same enterprise, now we've got a problem. Generally speaking, if you sense, this might be an issue going forward, start talking to the vendors about it now. They're usually pretty reasonable if you tell them in advance, hey, we're going to have manual processing and 2 sets of banks and 2 sets of everything for 3 months. And then we're going to convert over to you. Everyone will be happy. They're generally pretty accommodating of that because they know they're getting the business, right? They're getting those transactions, and at the end of the day, everything works out for them. If they find out later, though, that isn't a great recipe. That makes them unhappy. That makes them sometimes feel like you have tried to hide it from them. So always good to have those conversations early. Excuse me. One other tip, we've talked about it a little bit. If you're going to do that 2-step merge situation, and there's a lot of different ways to do it, But think really carefully about it, plan it really carefully, bring everybody to the table to talk about how to do it. There's a lot of potholes to navigate around in doing that. And the core contract stuff is only part of that, right? You're making sure you're not going against exclusivity provisions and stuff. That's only part. If that's something you're considering from a leadership and management perspective, make sure your operational folks are at the table to talk about that. There's a lot of bits and pieces. I think you will find that unless you're boots on the ground doing some of that stuff day to day, it might be really difficult to kind of figure out how to do on the fly. And if you've got anybody in the industry that you know has done those, talk to them about it. Talk to them about their experiences, the pitfalls, what worked, what didn't. Make an educated decision about doing that. All right. So we've talked a lot about what to do when a transaction is actually on your horizon, right? It's going to become a reality. But if you're at the stage now where you're negotiating some contracts, whether you're buyer or seller, and you think that strategically a transaction might be somewhere down the road for your institution, start planning for it now. If your Jack Henry contract is coming up next year, this is the perfect time to get rid of some of those obstacles or to at least soften them. So, you're thinking about selling. What can you do to make this a little easier on yourself? Obviously, I shouldn't even have to say it, but aggressively negotiate your early termination fees. Those aren't always comfortable conversations to have with vendors. They will tell you all about how consolidation in the industry has hurt their bottom line, and that's true. But that's not necessarily your fault, right? So you shouldn't necessarily have to pay the price for that with unreasonable termination fees. So take the time to negotiate them. There's almost always a reasonable compromise to be had there. Be cognizant of your long contract terms. Again, something of an obvious one, but if you think you might be selling your bank in the next 2 or 3 years, don't sign a 7 or 10-year contract. I mean, it's going to be easier, particularly from an early termination fees perspective, if there's a shorter contract term to deal with and to buy out. Pre-negotiated deconversion fees and other deconversion stuff. Like I said, a lot of contracts surprisingly don't actually acknowledge or have a lot of provisions addressing the mechanics of deconversion. It gets very expensive very quickly, and if it's not in the contract, there's a lot of leeway for vendors to charge you more, take more time, etc. Ask them about it. Ask them about what their deconversion process looks like, how much work and effort goes into it. Not all vendors and not all services are going to come with the same level of deconversion effort. You know, if you've got a wholesale mortgage contract, that might be a lot less work than your core processing contract, for example. So talk to vendors, ask them what that process looks like, and then try to start molding those contract provisions around what they're telling you. Carve-outs for assignment. So if you think you might be assigning a contract in the future, especially if the contract you're looking at has some pretty onerous notice or assignment provisions, or if they're really long or cumbersome somehow, build in some carve-outs. Think about successors and interest. Carve-outs for if you're assigning in a merger or assigning in a change of control or assigning in a sale of substantially all your assets, right? Your lawyers have lots of magic language to include in that provision, but think about when it's appropriate to maybe build some of that in. And then, of course, get copies of your complete agreement. You would be surprised at how many times people sign an agreement and walk away and don't actually ever get a complete copy of it. Sometimes, I mean, the vendors are pretty good about sending it to you, but sometimes it gets lost. Sometimes it comes in bits and pieces. Frequently, there's more than one document to your contract that doesn't make it all into one PDF, and then, some of it gets lost to the ages or lost to the recycle bin. Track that down. This is the time to do it. Also, if you're renewing your contracts, this is the perfect time to take a few minutes with your vendor and say, hey, I'd really like to wrap my arms around everything in our relationship. Can you send me a complete copy of our contract? You know, if there are old schedules or old exhibits or old, who knows? There's lots of old stuff floating around out there. But have them help establish what's current, what's not, what you can toss, what you can clean out of that scary drawer, and don't have to worry about when you go to sort it all out. One more thing I'll note on deconversion, because I hadn't really mentioned it before. You aren't necessarily, well, you're certainly not the only two parties involved in it, right? It's not just you and your vendor. There's a new vendor who's going to be involved, and there's a buyer. Deconversion stuff often comes with additional agreements. Deconversion agreements specifically are definitely a thing. Anybody who's deconverted probably has seen them before. They present you with roughly a 6-page document that outlines some of the deconversion stuff. And there's usually a tri-party NDA where everybody involved is going to sign it. That stuff is often presented with very little time to negotiate it, but they're not sign and drive type agreements. They definitely can take some negotiating. Ask for those early if you think they're going to exist, so you know what's in there. You can start, getting an idea of how to negotiate something that's favorable to you and favorable to your buyer. I mean, they'll have their own comments on it, right, to the extent they need to. But do yourself a favor and don't leave that till the last minute, because it's not always the first thing on the vendor's mind. All right, flipping the coin back to buyers. Negotiate your conversion fees. This is easier to do when you're a seller than when you're a buyer. The seller vendors know what it costs to get you off their platform. They know who you are, what your asset size is, etc. When you're a buyer and you say, I'd like to pre-negotiate conversion fees for an entity that you don't know how big it is, you don't know how many accounts there are, you don't know what states they're in, that's hard to do, and that's understandable. But it's worth having the conversation to see if they've got preferred language they like to use there, to see if they've got something they're willing to do. It's not unreasonable to ask for that stuff. Alternatively, if you can't come to an agreement on, what a reasonable cap might be, think about credits, the flex credit type stuff. If you can build into an agreement, hey, in the event I convert another entity onto your platform, and then, hey, you get more revenue from us bringing you more business, negotiate a credit for that. You'll get a $50,000 flex credit for convert. I'm pulling that number out of thin air. But that's a conversation worth having. Favorable treatment for targets on the same platform. Vendors obviously don't like to lose business in transactions, and it's happened to them a lot lately with the consolidation in the industry. But if you can tell them, hey, in the event I convert another Jack Henry bank, and you, Jack Henry, are not losing nearly as much revenue, maybe you give me a break on my conversion fees. I've seen that. Carve-outs to exclusivity provisions. If you think that, especially if you've got an enterprise-level contract and you think you might be acquiring some new charters that will operate independently, take a good look at whatever is proposed for your exclusivity contracts. There might be some room to negotiate there, especially if you think there might be a temporary, lapse where you might have two competing contracts. Talk to them about that. They're usually pretty reasonable in saying, hey, we understand it might take you 3 to 6 months to onboard or convert. So, in the event of a transaction, you'll have an out from this exclusivity provision for a reasonable period of time. I've seen that too. They're usually pretty reasonable about that. And then, of course, additional fees, because as we know, everything with contracts and everything in banking comes with additional fees somewhere. There are often fees hiding in your contracts that don't look like fees. They don't use the word fee. They sometimes use the words out-of-pocket costs, or expenses is a good one. So if you search for fees in your contracts, you won't find it. Stuff like assignment expenses or fees, stuff like transaction fees, sometimes they're squirreled away in there, and that's just another piece of that, knowing your total price tag. You can know some of your price tag in advance if you start adding up what excess additional fees might be hiding in your contracts. All right. So as a final comment, we highly recommend, as your advisors, work through these contract issues as a team. One of the worst possible things you can do, well, I shouldn't say worst possible, but one of the worst things you can do here is to negotiate these contracts or try to tackle these conversion and melding of two business issues just as your executive leadership team or just as your board. Keep your operational people involved in this, the people who do this on a daily basis and understand how your products and services and customers work, the nitty-gritty stuff, really important. And not to cast it as a commercial, truly, but involve your counsel and your consultants and your financial advisors. We do a lot of these, and so we usually have a couple of good ideas. But it's, it really is a team approach that you'll be better served if you embrace that part early. So that about wraps it up. I know this is going to be a tremendously busy M&A season for all of us. I'm sure that lots of you have deals in the pipeline, many of which are attempting to close by year end, probably for tax reasons. But it's going to be very busy, so I hope some of this is timely. And Tom, if we want to entertain questions, we can.
Anybody has questions? Now's a great time. Looks like we have one back here.
What do you see respecting buyer, seller, or late fees on fees? Does each party take care of its own, or is that subject to negotiation just like everything else?
Just like everything else, it is subject to negotiation. I've seen it work out in a variety of different ways. I've seen buyer pays all. I've seen seller pays all. And I'm talking, deconversion and early termination, not general transaction expenses. But the vendor fees, it really does range. I've seen escrow situations where, if the fees aren't entirely certain yet, we hold some aside in escrow and draw off that to terminate contracts. So it's, often we'll see stuff in offering memoranda that say how the seller wants to approach the early termination fees, and very frequently now, almost always I should say, in LOIs, they'll say how buyer wants to approach early termination fees. So definitely up for negotiation.
Have you ever run into a situation where this issue becomes a deal breaker?
I have not personally, but I know it has happened. I have seen it almost ruin deals. I've seen it significantly delay deals. So, but I know, and there are probably a few more veterans in the room who have seen it terminate a deal or two. Harry.
Don't forget about one more vendor out there that charges fees, and that is the Federal Reserve Bank.
You are correct, sir.
Notifications of change can get expensive, can't they, John?
Yes, they can.
That's a very good point, Harry. Yes, we sometimes we forget that the Fed is one of your biggest vendors in addition to one of your biggest regulators. And the applications folks don't talk to the services folks. So yes, excellent point. All right. Well, thank you, everybody. Much appreciated. It's been lovely to be back in person and to see some of you again in person as real humans for the first time in 2 years. I hope you all have a lovely evening and enjoy the rest of the conference. And thank you again to Tom.